You work hard for your money, but just sitting in your wallet, it constantly loses value. Inflation eats away at your purchasing power, quietly making every dollar worth less than it was yesterday. You feel this most acutely at the grocery store. A carton of juice that cost $2 a month ago suddenly costs $3, forcing you to think twice before putting it in your cart. Those local price spikes usually start thousands of miles away. When millions of people suddenly want to buy more goods, but shipping ports are backed up and supply chains are constrained, the limited supply drives prices through the roof. When inflation spirals, the job of stopping it falls to central banks, like the US Federal Reserve, the Bank of England, or the European Central Bank. But here's the problem. Central banks don't drill for oil, manufacture microchips, or sail cargo ships. They cannot physically create more supply to meet high demand. Their primary weapon is entirely abstract. They gather in a boardroom and vote to change a single baseline number. That number is the interest rate, the baseline cost of borrowing money, and the financial reward you receive for saving it. So how does tweaking a percentage point in a government boardroom actually lower the price of juice at your local grocery store? Think of a central bank as the bank for commercial banks. High street lenders, the places where you get a mortgage or open a checking account, also need a secure place to store their own cash. Commercial banks manage extra cash, called excess reserves. They choose, lend it to the public, or deposit it at the central bank. When the central bank raises rates, it offers a bigger reward. Banks make guaranteed profit leaving money there, instead of risking loans. By offering this higher payout, the central bank successfully drains money out of the public economy. Commercial lenders tighten their belts, and the total supply of available cash shrinks. Because commercial banks are hoarding their cash at the central bank, the loans they offer to the public become much more expensive. They hike rates on credit cards, rates on auto loans, and business financing, just to make it worth their while. For everyday homeowners, especially those with variable rate mortgages, the impact is immediate. Their monthly housing payment jumps, leaving them with far less spare cash to spend on things. The corporate world feels the exact same squeeze. Companies that rely on credit to build factories or buy equipment suddenly find those expansions too costly, forcing them to freeze their spending. Debt repayment acts as a spending trap. Both households and corporations stop consuming and are forced to use their income to pay down what they owe or build their savings. This chart illustrates the shift. As interest rates climb, consumer demand takes a steep dive. Expensive credit and reduced spare income mean people stop buying things. With fewer customers, businesses lose pricing power. They stop raising prices and instead offer discounts. This engineered cooling of the economy brings artificially high demand back down to match the constrained supply, finally stabilizing prices. Intentionally slowing down economic growth comes with a severe domestic cost. When businesses stop investing and consumers stop buying, companies cut jobs, raising the risk of throwing the entire country into a recession. The impact also crosses borders. When a major institution like the Federal Reserve raises rates, global capital rushes into the U.S. banking system to secure those high returns, making the American dollar significantly stronger against other currencies. A strong dollar traps developing nations. Many of these countries borrow money priced in dollars, so when their local currency devalues, their debt payments skyrocket. When these countries default, the human toll is immediate. Depleted foreign reserves and collapsed local economies lead to severe political crises and widespread poverty. Interest rates are a blunt instrument. In the effort to tame domestic prices, central banks export economic pain to the most vulnerable participants in the global financial system. Making this even more difficult is a heavy delay in the brake pedal. When a central bank adjusts a rate today, it can take up to 2 years for the full result to filter through the economy. Central bankers must find a narrow path. They have to raise rates high enough to halt inflation, but keep them low enough to avoid triggering a catastrophic crash, all while guessing what the economy will look like 2 years from now. While these rate hikes cause job losses and trigger slowdowns, central banks view the alternative as worse. Uncurbed inflation permanently erodes wages and destroys purchasing power. Final, resonant tone. Central banks use interest rates to inflict controlled, immediate economic pain today because it is the only reliable tool they have to prevent a systemic collapse of purchasing power tomorrow.